All right, welcome to IR in Focus. I am your host, Carmen Lilly, and we are back after a short summer break, and I hope you, our listeners, have had a chance to relax and recharge this summer. For this episode, the next 20 minutes will be dedicated to discussing what the rest of 2024 has in store for us and digging deeper into economic indicators and investor sentiments. If you attended NERI last month in San Francisco, you should be familiar with my guest today. He was a keynote speaker, Chris Williamson. Chris is a well-known economic commentator and is regularly quoted in international business and broadcast press and frequently speaks at conferences on global economic issues. Chris joined the company via an acquisition in 2008 and has played a major role in developing the firm's world-leading business surveys and economic indicator products, including the PMI series. The PMI surveys now encompass all major economies and are commonly cited as some of the most important sources of economic information available to central banks, financial markets, and business decision makers. He studied economics at the University of Nottingham and economic development at the University of Manchester. And welcome, Chris.
Thank you, Carmen. Hello, everyone. Thank you very much for having me. It's a great time to be talking about economic conditions and investor sentiment. It's certainly a lot going on at the moment.
I totally agree with that. So jumping right in, let's talk a little bit about taking a look at the next 12 to 18 months. So what is your current assessment of global economic outlook, and what sort of key indicators do you monitor in order to make this assessment?
S&P Market Intelligence is the area that I operate in, and we forecast here. This is separate to the ratings business of S&P Global, but we publish our forecasts updated basis, the very latest of which we've grown quite optimistic this year, really. Certainly, if you remember late last year, there was a lot of concern about recessions. All the indicators were turning down. Lots of people expecting lots of interest rate cuts this year. That didn't happen, of course. The economy picked up and the overall economic scenario seems to be brighter. I mean, so we're forecasting 2.7% growth in 2024 after 2.8% in 2023. And in fact, that 2.7% we've got for 2025 and 2026. So a very flat picture over the next couple of years for global GDP. There's lots of variance by countries there. Essentially, the big geographical variance is growth slowing in the United States as we go into next year and also slowing in China, but growth picking up in Europe. Although it's got to be noted that European growth is coming from a low base. The US has clearly recovered from COVID much faster than Europe. So there's an element of catch-up going on there. But overall, the broad picture is that steady growth scenario. As to what indicators we watch in that, the obvious ones are, the GDP and labour market data such as non-farm payrolls, and inflation's clearly a big one as well at the moment because that's steering where interest rates will go. It's not a problem we had in the decade prior to the pandemic, but inflation is now catapulted to one of the key indicators you've got to watch for those central bank decisions and how that's going to affect borrowing costs. There's a lot going on, but what's important, I think, is for every investor is to try and get ahead of the curve there. So, for example, today we've got GDP data that come out, showed stronger growth in the second quarter for the US than we saw in the first quarter. Now, by tracking data such as the PMI data that we produce, the Purchasing Managers Index, you will have seen that in advance. We've been signaling for some time that the economy is accelerating, and also encouragingly that inflation pressures are coming down, a sort of benign soft landing scenario for the economy. So look at those. Don't just look at the hard data, what we call hard data, like the GDP, the official statistics. You can get a good steer on where they're going from the soft data, as they call them, the business surveys, such as those PMI numbers.
Yeah, and speaking of inflation and how the different economies are working through that and trying to manage that. So we've seen a divergence in the timing of central banks easing interest rates and responding to the post-COVID inflation. For example, the last month, we saw Bank of Canada, which was the first to cut rates, followed by the European Central Bank, and most recently, China cutting its benchmark lending rate on Monday. So how will that impact major economies like the US, China, and the EU in the near future?
The most obvious impact is through exchange rates and how these long-term rate differentials can affect currencies. But beyond that, I think we're in a general easing cycle here. Those exchange rate differences, once everyone gets into progress of cutting rates, then those exchange rate differences will become less important. But in terms of that timing, it's important to assess why rates are still so high. The pandemic caught a lot of people out in that inflation picture because of over focus on manufacturing. If you look at the way most economic models are built on where the data is available, obviously, if you've not got data on a part of the economy, you can't put it in your model. What we've seen is these models have been dominated by data on manufacturing because it's easy to measure the output of a factory and how much they're charging for some food on a shelf in a supermarket. Those are very measurable concepts. Much harder to measure what's happening in the service economy and what service companies are charging for their goods. What a lot of business to business services, there's no sort of open market traded price for those. So data there is very hard to come by. And that's what caught the central banks out. So in the pandemic, we had this initial surge in demand for goods with constrained supply that led to goods price inflation accelerating. Then when we got the vaccines, everyone got very excited and ran about going on holiday and so forth. So demand switched from goods to services. And of course, what happens then is that you get your price surge rotating from goods to services. But because people didn't have all that service sector activity in their models, they didn't see that coming. So this is why late last year, people were saying, well, inflation's already beat, right? That wasn't the case because we've had this service sector surge. It's keeping inflation going. So the point of going through all that is to remind us, why we are where we are now. And that is seeing this tail end of that post-pandemic service sector price surge. Great demand for things like travel was occurring at a time of constrained supply. The constraint in the service sector was people rather than raw materials. Weren't enough of us to get people on planes or whatever. So that is now starting to ease, but it's a slow process because a lot of that is all about wage negotiations and they take time to filter through. But, inflation rates have come down from the double digit ones. So you can't now start really pushing for really high wage rates. So these wage negotiations are coming down to more normal levels. And so most people are expecting that to start feeding through into sustainable low consumer price inflation to come. So everyone's going to be moving into this easing phase pretty much at the same time. There will be differentials though, and that's to do with how flexible your labour markets are. And one economy in particular is struggling there, and that's the UK, where Brexit meant there's a lack of imported labour, immigrant labour coming into the UK market, helping to keep a big pool of willing available labour. So here in the UK, our wage cost is probably going to be stickier than economies with much more flexible labour markets. But that said, everyone's labour market's pretty tight at the moment. So we're seeing this inflation cooling, but not going back to where it was prior to the pandemic because of those labour market and wage factors, as well, of course, as other ones. Supply chain resilience. We learned in the pandemic that we need to have better supply chains globally. If you import goods from Asia into the West Coast of the US, perhaps you want some supply chains coming into the East Coast as well. So we're seeing this diversification, nearshoring, reduction in global trade flows as people bring production of components nearer to their manufacturing base, for example. That's all added cost. It's all costlier. The reason why we outshored stuff in the first place was to take advantage of lower cost production areas. And if we're moving back from that, everything is going to cost more. So inflation rates aren't coming back to where they were prior to the pandemic. There's that stickiness there, which means interest rates are going to be stickier as well, a little bit higher.
Yeah, and that's interesting to hear your perspective on that in terms of, kind of domino effects that we see in these markets playing out. And we know that central banks play important roles in managing these economies. And so when you look at the U.S., going back to some of these data points here. So Jerome Powell, he appeared before lawmakers earlier this month in July I mean, it's in a moment where the economy is kind of in a tricky spot. So inflation is well below its peak, like you mentioned, but still higher than the Fed's target. At the same time, there's some cautiousness around the most recent jobs report. It shows unemployment rising, and the jobless rate rose to 4.1% last month. And that's the highest it's been since 2021. So that's leading into my question. So what role do you see central banks playing in the future in managing economic stability?
I don't think there's any big change in the way central banks are going to be operating in their mandates. There's been talk of some reviews, but I think things are going to stay the same pretty much as we go forward. The uncertainty is, of course, the Fed and post the election. If Donald Trump becomes president again, we may see some change there. He said he'll retain Powell for the rest of his tenure, but as we all know, it's uncertain times. But, we have to really operate on the basis that the Fed will keep its dual mandate of full employment and price stability. So in that respect, we have it on course to cut rates we've got one rate cut in December penciled in. There may be one in the summer imminently, but we've just had some GDP data out, which have been pretty strong. So markets are trying to digest that. But all along, we've had one Fed rate cut for December with the European Central Bank and the Bank of England cutting 2 more times. So as I say, everyone's sort of helping engender recoveries by taking the top off those policy rates. But they've got other work to do as well, especially in Europe, where the European Central Bank has got to keep a close eye on the sovereign debt markets. Those bond markets, they're very vulnerable to political change, as we saw with the French elections. When bond yields start spiking because investors are worrying about fiscal policy, for example, government spending more than they should, that's a recipe for inflation to pick up again. So the ECB's got to watch that. They could be worried about bond market routes as well. They've got tools to deal with that. They've got something called the Transmission Protection Instrument, the TPI, which means they can buy bonds that are in trouble because people have essentially lost faith in governments. But we're not there yet by any stretch. There's a lot going on in politics at the moment, but it's just adding at the moment another plate, if you like, for the central banks to be spinning, to keeping their eye on those fiscal elements of the economy to make sure that that fiscal side's not going to start endangering their inflation outlooks.
Yeah, and I'm glad you mentioned that because it is a big year for elections and the potential for government disruption. Any elections in particular that you're following closely, and any surprises coming out of the elections held in the first half of the year?
Well, obviously the one we're most focused on is the US presidential election, as is everyone. But, so far, I mean, this was a year, right, where half the world's population apparently were going to the polls. So it's a year where political uncertainty is higher than it's been for many, many years. There's a lot of risk assigned to many of these. Some elections so far have come in as we expected. Some have been more surprising, and some elections themselves have been surprises. So the surprise really was in India, where the reduced majority for Modi's party was a big surprise. We've seen the economic data hold up since then, but we have seen businesses grow more uncertain about what that means for the policy outlook. And it remains to be seen just how much the Indian government can get through from its policy framework. In France, there was the snap election. We weren't expecting that one. That, as we mentioned before, has already upset the bond markets. And it's fueling a greater concern about stability in the European Union because we're getting more populist parties, more right-wing populist parties gaining a voice in Europe. And a lot of that voice is calling for greater spending, more trade protection and so forth, all of which is, from a purely economist point of view, is dangerous for inflation and is bad for global growth and global trade. Those two elections are somewhat concerning, especially the French one. In terms of the lack of surprises, that came through with the UK general election, where the Labour Party gained a very strong majority. That was widely trailed. We saw that coming, as did everyone. But I think what's important there is, especially from an investor perspective, is how you look at that UK election in the context of what happened in France and in continental Europe. Because it's now looking like the UK is is showing greater political stability in the region than anywhere else, which is not something you would have thought a year or so ago. So the Labour Party is very pro-business. It's approaching policy and the management of the country with what seems like a very sensible level head. It is not reactive. It's not stirring dissent or divisiveness. It seems on balance to be trying to create a pro-growth agenda that is going to be very favourable to markets. And at the same time, you've got all this instability in Europe and in the US with uncertainty about the election. So from a UK resident, it's quite surprising after all that's happened since 2016 and the Brexit referendum to suddenly see ourselves as potentially a bit of a sort of island of tranquility and stability all of a sudden.
And so with all of this in mind, thinking about the geopolitical and the macroeconomic background here, turning our attention to and digging into a little bit more on investor sentiment, could you tell us what are some key trends that you're observing in investor sentiment at this point?
Sure. Yeah. So just as we track business conditions through the Purchasing Managers Index, the PMI, we track investor sentiment through the Investment Manager Index, the IMI. So this is a monthly survey that we conduct. We've got a panel of 300 investors. These are respondents. They could in very large mutual funds or hedge funds. The whole gamut is covered by the panel here. Collectively, they'd manage $3.5 trillion worth of assets. So it's a reasonably sized panel, and it feeds us information each month on what investors are thinking, what's their risk mood, what sectors are they interested in, and what do they think is driving the market, and what are their concerns. So we saw the risk attitude amongst this panel improve earlier this year, but it's taken a bit of a knock in July. We collected data right at the start of the month before some of the big tech earnings that we've had come through that have been a bit disappointing. But what we see here is that number one worry that they've got that knocked the confidence was the political environment, these geopolitics. So there's a big fear that this is going to have a knock-on effect to certainly the US stock market. And in that context, they're looking at valuations and saying, well, hang on, our company is going to be able to grow at the rate that we want in this environment of political instability. So the political environment and valuations, they're the two big factors. But having said that, they've been there for kind of a year now. They just got a little bit worse in July as drags on the market. What became a turnaround in sentiment, though, a bigger factor that changed, was their views on the global macro environment. So investors were suddenly saying, well, hey, hang on, we're starting to downgrade their forecasts going into the second half of the year. We're in the good times now, and it's going to get worse from here on potentially. So the US macro environment and the global macro environment in particular have been much less supportive to equities than they have been. In that respect, central bank policy is starting to become a bit more positive as they think, well, you're going to get some economic weakness come through and they're going to have to do more to stimulate stuff as we go through later in the year. So that's coming through investor sentiment. But I think what's interesting is the two factors that are dominant in continuing to drive investor sentiment and keeping the sort of the mood alive is shareholder returns and views on equity fundamentals. And I think this is interesting because it says, despite all these other factors, investors are still thinking decent enough earnings can be made. They can be sufficiently strong fundamentals to drive earnings growth. But the key thing to bear in mind is all these other factors becoming increasing worries is that can't last forever. You need to get these other supportive factors coming in. The political environment and the macro factors have to come in to support those earnings longer term. You won't keep those equity fundamentals for long if your broader macro environment doesn't start improving.
Yeah, it's interesting that you say that around, so investor sentiment still being positive on fundamentals. So digging in just a little bit there with maybe some commentary around specific sectors. So this week, big story in the US markets is big market moves with Tesla and Alphabet posting disappointing earnings and the huge tech sell-off of the Magnificent Seven following that. Personally, I think this is highlighting just how much optimism investors have had in AI, and that's lifted the tech stocks for quite a while. So thinking about other sectors, are there other sectors investors see poised for significant growth? Or you can answer this on the flip side, are there sectors potentially facing significant challenges, maybe macroeconomic challenges that you were referring to?
Yeah. So again, the IMI survey tracks these sector preferences. And what we've seen, well, this was early July. So this is before a lot of the earnings announcements. Again, the most favored sectors were what you'd probably call defensives, right? Things like healthcare and energy. That's where the money was moving into, it seemed. IT, tech was still amongst the most favored, but it had lost a lot of favor compared to prior months. So this is even before some of those big earnings like Tesla that we'd had. This was a big pullback in sentiment towards tech stocks that we saw early in the month. So, dominated by those defensives, really. The higher for longer rates environment meant that investors were still very much shunning the real estate sector and consumer discretionary. They were suffering as this view that, you might still just get one rate cut from the Fed this year. Now, some other sectors that are looking a little bit more interesting, perhaps, and suggesting that indices like the S&P could get support from a broader market beyond tech, is sentiment around sectors such as basic materials and industrials, where we're seeing investors start to move back in because of this manufacturing turnaround globally. We talked before with the post-pandemic demand shift from goods to services. It's now starting to even out again. You're starting to get demand coming back into goods. We're also seeing the inventory cycle become more supportive around the world. There's a lot of inventory reduction that you had after the pandemic when they amassed too many raw materials for safety considerations during the pandemic, left them completely overstocked, and we spent the best part of 2 years running those down. They've run down now, and they're starting to build these inventories back up again, especially in advance of the upcoming holiday season, potentially. So we're seeing it wavers, but as on a general trend, you're seeing some improvements in sentiment towards those sort of basic materials and industrial sectors come through. And I think that's an interesting area to watch.
And then at play here, what I often find myself talking about on my podcast and talking about with the IR community is still how we are thinking about and how we're balancing sustainability factors. So things like environmental, social, and governance factors that a corporation or strategies that a corporation employs. So how are those sustainability factors influencing investor behavior or investor sentiment?
Again, it asks investors, how do you see certain issues impacting your investment decisions over the next 3 to 5 years? And these are sort of ESG-based ones. And the number one, by a long way, factor that is interesting them from an investment decision-making process is data privacy, which of course includes cyber. Interesting whether that would include the CrowdStrike type issues, but the whole data side of things is the number one priority by a long way. And after that, more secondary considerations that excite them, executive compensation and board compensation. So these are the factors that investors are looking at most closely. They want positive news or signals on those to be interested in a stock. At the other end of the spectrum, by a long way, is diversity. It's total turn off, not interested in that. Climate change, a path to net zero, that's just right down at the lower end of investor interest. Labour standards also, and pollution is just in the sort of positive, let's have a look at that and make sure that's in line with what we are prepared to be investing in. So it's quite a gamut there. And it's quite a surprise, really, I think, from the sort of ESG side. The environmental aspect is not of interest. The governance side is, and even sustainability is is not particularly interested. So it's all about that whole data privacy and getting the right people running the company through proper compensation.
Yeah, that is interesting commentary there. When I think a lot of people, when they think about ESG, they solely focus on the E part, the sustainability part. But we have to remind ourselves that it really does run, like you said, it does run the gamut of issues here. And it looks like investors are particularly interested in what you had mentioned, like data privacy and the executive comp and the board comp, or the board composition on, is this board, qualified to run this company in a way that proves a path to profitability. Interesting. And I'm wondering if you've seen, just to follow up on this, seen fluctuations, like big fluctuations in that, in terms of what investors care about across the sustainability board from month to month?
Generally, these factors are sort of ranking pretty similarly. I would say data privacy is trending higher as a factor, a positive factor. Board composition has been very stable, and diversity right down the end. Climate change, that was viewed as a positive factor to be looking out for, but it's gone negative since late last year. So that's quite a recent development, that climate change is just not viewed as important to investors anymore, which is, clearly a concern. They're not focusing on that. So I'd say that's the big change, that whole climate change side of things.
And I'm wondering if some of that sentiment comes from some of the macroeconomics that we're seeing, we're just a return to fundamentals. We know sustainability initiatives definitely come with a cost. But I'm also wondering if some of that sentiment has to do with, we have a lot of regulations now being rolled out. So maybe it's not quite a concern, because we think that with these regulations, these companies are going to be self-reporting and will be able to have that information at hand to make these investment decisions. But in any case, I think that's interesting to point out there across the sustainability spectrum, what investors are caring about most. And we're just about at time now. So I wanted to leave with a little bit of advice for our listeners. And given you've shared great insights in terms of what's happening geopolitically, macroeconomically, indicators and investor sentiments that we need to keep an eye on. But what is one piece of actionable advice that you would like to leave our listeners today?
Well, I guess, and it's probably no surprise given the background I have, and that's to encourage people just to look at as much data as you can. That you can never have enough data, I think. Certainly, if you look at central banks, they're always of the view that give us as much as we can. We need to make the best decisions. Investors should operate the same way. And if you look at central banks, how they set interest rates, they don't wait to see the GDP numbers, the non-farm payroll numbers. They have to be setting their decisions ahead of the game. They've got to be moving ahead of current conditions. They've got to be anticipating those. And the way they do that is by looking at a broader breadth of economic data. And that can include so-called soft survey data as well as the hard data. As we mentioned before, you've got to be able to anticipate things like GDP. If you look at things like the Purchasing Managers Index data that we produce, other surveys are available, that will give you a steer on what that GDP is going to do. And you can move in advance of the market, and you can anticipate what investors' behavior is going to be doing by looking at those soft data, the surveys. And don't be afraid of surveys. This distinction between soft and hard data is a complete fallacy, because hard data, your GDP data, is derived from surveys of households, surveys of businesses. The only difference is they try to put a very hard number on the amount of output produced or the actual price, instead of having surveys sort of directional change, going up, it's going down. That going up, going down can be hugely insightful. And again, all this stuff's usually based on surveys, with a few exceptions. So maybe try not to be too restrictive on what you look at. Treat all data as potentially useful data to guide your decisions. Look at as much data as possible.
I love that answer. I love looking at data part of what I also love is just like anecdotal data, but what you're talking about in terms of surveying large groups of people obviously lends more weight to those opinions and that forecasting. And I love your recommendation there. Just look at all types of data, whether it be the quote unquote soft data or the hard data. Well, thank you so much, Chris. That is all the time we have for today. Again, thank you to my esteemed guest, Chris Williamson, and thank you to our listeners. And as always, feel free to reach out to me with comments, questions, concerns, or even topics that you want to hear on new episodes. All right, so catch me next month with a new episode. And until then, happy listening. Thank you.